Hi, welcome to session. Today we discuss about the ratio analysis. In that we find out the turnover ratio. Various assets are employed in the business to generate revenue and profits. It is based on the various assets employed in a particular business to generate the revenue and profits. These assets need to be managed efficiently for the purpose, because it is the earning the profit is not a matter. That profit is used for or managed efficient way for the particular purpose. Better managed asset help to generate higher profits for the business. These activity ratios are also known as a turnover ratio. This is the earning the profit. That profit is managed in efficient way. That calculation is called as the ratio is calculated as the turnover ratio. Based on the several turnover ratios are: first one is fixed asset turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio, total asset turnover ratio. These 6 are included in the turnover ratio. We discuss by one. What is the fixed asset turnover ratio? Already we know that fixed asset, what are all the fixed asset and what are all the current asset. So fixed asset ratio, we find out the net sales divided by net fixed asset. Okay, fixed asset turnover ratio attaches fixed asset with sales revenue. This ratio shows the efficiency with which the business uses its fixed asset for the purpose of generating revenue and profits. A high fixed asset turnover ratio shows that the company is quickly turning its fixed asset into sales. In other words, it is told that higher sales per unit of fixed asset are being achieved. Fixed asset are an important criterion as they form of largest portion of the total asset of the firm. Okay, how to calculate the net sales? Gross sales minus sales return. Okay, net fixed asset, gross fixed asset minus depreciation, we can get the net fixed asset. Okay, next we discuss about the stock turnover ratio. Stock is nothing but inventory. This ratio is called as inventory turnover ratio or stock turnover ratio or stock velocity ratio. The relationship between the cost of goods sold and average inventory, find out the stock turnover ratio. Cost of goods sold divided by average inventory. In that we find out cost of goods sold, sales minus gross profit. Okay, average stock, how to find out the average stock? That is the opening stock plus closing stock divided by 2, we can get the average stock, because every year opening stock is calculated, plus that year, end of the year, what is the closing stock of the company. We adding the 2 divided by 2, we can get the average stock level. Okay, next we can calculate the inventory conversion period. How to find out the inventory conversion period? We can find out the 12 months or 52 weeks or 365 days divided by stock turnover ratio. We can find out the inventory conversion period. For example, 365 divided by inventory ratio, or 52 weeks divided by inventory ratio, or 12 months divided by inventory turnover ratio. We can find out the number of days. Okay, we find out the stock turnover ratio in that calculation of the stock turnover ratio, and also it is based on the inventory conversion period. Thank you.